Hello and welcome. My name is Melissa Galasso, and I'm super excited to be here with you today to talk about two ASUs that were issued by the FASB. These are much awaited, and in fairness, FASB had promised them by mid-November, and right on November 15th, we received ASU 2019-09 and ASU 2019-10. So this is a 2-for-1 special. We're going to cover both of them because they are all impacting the same thing, our effective dates. So ASU 2019-10 is going to impact topic 326, which is the credit loss model, or CECL, topic 815, which impacts our hedging standard, and then 842, which is our leases standard. So there's 3 standards that will be updated in ASU 2019-10, and then ASU 2019-09 impacts our insurance, so topic 944. All of them, however, are impacting our effective dates. So let's think a little bit about that. There are some that are going to impact the effective date for all, in particular insurance, and then some that are just going to impact it for private companies, which is probably why we end up with 2 separate ASUs. So we're going to start with the most awaited one, but then we will dive into the insurance one. The other one has a lot of meat to it, and I thought that we would like to talk a little bit about how we got here before we really dive on in. So again, hitting on ASU 2019-09 and 2019-10, which delay the effective dates for 4 different standards. So quite a bit going on here. All right, so let's think about this. How are we going to have an impact? So first off, 2019-10, right? So starting with the big one, it was issued, as I said, in November of 2019. And really, it had to do with a lot of feedback that was received by public companies and also private companies and their auditors talking about the implementation challenges impacted by public companies. When public companies are telling you not to really think about their Qs as final and that they're still a work in progress before they get to their K, you kind of know that this is an area that's going to be very interesting. And what we found is that when we know public companies are being challenged, private companies are equally challenged in this scenario. So they received several requests from various entities. So some are from industry items or industry entities that were trying to encourage a delay. Some even came from the AICPA. The AICPA's Technical Issues Committee sent an unsolicited comment letter regarding the need for a delay. And then we started to see softening when we got to the AICPA's NATS conference, the National Advanced Accounting and Auditing Technical Symposium. At that, they had a private company town hall, and they had several members of the FASB there. And you started to hear, even back in June, that this was something that they were starting to really consider given that item. But what's cool about this standard is it's a lot bigger than many people tend to think, right? So they tend to focus on the fact that they're just delaying the lease standard, or they're delaying the credit loss standard, whatever one is of most interest to you, depending on your industry. But it's a bit bigger than that. So let's take a look here at some of the key elements. First off, why did they do this? Well, they know that they had some issues and they wanted to look at it, right? We have a private company decision-making framework. That private company decision-making framework tells us that certain things are just more difficult for private companies. So first off, availability of resources, internal and external. The external auditor typically comes out once a year. They don't come out 4 times a year like you have for public companies. They tend to have smaller staffs. Now, this is a generalization. There are plenty of public companies that are super small, and there are plenty of private companies that are super big. But we're just talking in generalities. They also talked about the timing and sources of education. We know that private companies typically rely on their auditors to receive a lot of information, or CPE. So things that happen once or twice a year, not necessarily that they're hearing it as it comes out, right? So that's always been a big factor. And we know that private companies leverage the knowledge and experience that implementation issues coming from larger public companies. So when larger public companies are having trouble implementing, people start writing news articles about it. There's been some really great Big Four articles on some of the issues that have been encountered that then private companies can use to their advantage. And then just the transition requirement, right? Being retrospective, having to restate items, we know that takes a lot more time. And then obviously when we look at post-issue and standard setting guidance, right? So as they go through that standard setting activity, we learn a lot more about what it took, right? So FASB was able to obtain some information as public companies were going through this. And then just thinking about the development or the acquisition of technology, right? So information technology is important to public companies, but also private companies. So how are they going to create and implement new systems or change their systems to make sure they're effective? That's a big undertaking. Also, internal controls and business solutions, making sure that everything works together. And then better data or estimation processes, as these tend to be heavy on the the super, full estimation, really focused on that principles-based approach, then you really have to have strong controls in that area because these estimation uncertainties. As a result, what we find is that this is going to be a big undertaking. So when we think about who is in this other group, right? Who is struggling? Well, we know private companies are struggling. We know nonprofits are struggling. And then in there, they also included smaller public companies, right? So we recognize that while we generalize public companies to be these large mammoth items, that there are smaller public companies out there, and they also struggle with the implementation of these standards. And then they also tossed in employee benefit plans. So when we're doing this, when we think about this, there's something called a smaller reporting company, or SRC, and an SRC is an SEC specific concept. So in order to be eligible to be an SRC, you must be an issuer as defined by the SEC, and they have established levels of public float, annual revenue that you would have to meet to qualify. And then under that definition, investment companies, asset-backed issuers, and majority-owned subsidiaries are not eligible for SRC status. So there are certain rules about who can have it and who cannot. But as they go through this, what we find is that it really does help those smaller entities that while they're public, they tend to also have fewer resources available. So why do I like this standard? Well, one, I love the delay in the effective date, but what I really like is the change in philosophy. And this is going to be what really, I think, changes for many people and really helps them, is that major change in the effective date philosophy. So first off, a major standard is going to be decided. So they're going to basically have a two-bucket approach. They're going to have a standard that is changing but not massive, and then what they call a major standard. And if it's a major standard and it's going to be very heavy, very difficult to implement, like RevRec, like leases, then they're going to give us a 2-year delay. So right now, the default under the private company decision-making framework is a 1-year delay. Public companies go the first year, and then in year 2, you would get private companies. Under this one, we would actually skip to year 3, giving them a year to really leverage from that public company. And so this would be for those smaller public companies as well as those private companies and nonprofits. So this standard is so much bigger because it's not just the 3 standards it's going to delay. It's all future standards that end up falling in that major bucket. So I think that that is the biggest takeaway from the standard. Yes, it's delaying effective dates for 3 standards, but it's a change in philosophy for the FASB. And I think that's really awesome. So let's talk about what the effective dates are going to be. So for hedging, ASU 2017-12, the SEC filers, they're not going to change that because if you look, it was effective January of 2019, right? So they've already implemented this, theoretically. In addition, all other public business entities are also not changing because, again, there was no scope exception for them when they were initially written. And so as a result, they're not going to delay that one because they should have already been implementing it. However, private companies, you can see, instead of being 1 year later in 2020, this standard will delay it to 2021. ASU 2016-02 leases, the one that got most of the attention here, that was already effective, as we said, for SEC filers. So no change for them and no change for other business entities. But you'll notice that little asterisk there. It does remind us that that also applies to not-for-profits that are conduit bond obligors or employee benefit plans that file with the SEC. So in that scenario, because they were already scoped into leases as having the original effective date, no change for them. So they're going to continue to be in there. They're not going to be in the private section. But nonprofits without conduit debt or employee benefit plans that don't file with the SEC, those are going to be in the private company. So no changes for SEC filers or all other public business entities. However, private companies, you can see that extra year now. So 2-year delay from the public company date, so January 2021. And then CECL, this one again, not changing for public business entities, but is changing for SRCs. So if you are a smaller reporting company as defined by the SEC, you are going to get the private company and all other public company definition. So while they are SEC filers, they're going to fall under the all other public business entities. And so we're going to get that 1-year delay here for them as well. So that is a really cool one in terms of the effective date. So I think that's very, very important. Now, there is a little bit of a byproduct here because ASU 2017-04 was intended to be effective at the same time as credit losses. It does change the mandatory effective date for the elimination of Step 2 from the goodwill impairment test. So remember, Step 2 was taken away by 2017-04. The board's intention initially was to align the mandatory effective date of goodwill with credit loss, so they are also going to make that effective as well. So they're kind of combining them together. So really important standard, lots of opportunities for us to get some more learning on about leases, about hedging, about CECL for private companies, leverage what we learned for public companies, and implement those standards with a little bit more, breathing room. Now, not different is ASU 2019-09. So very similar issues here. This is related to insurance. This was issued same day, but it's a little bit different, so it gets its own standard. So first off, we have the new philosophy, the 2-year delay on major standards, but also overall implementation issues. So what we found is while they were looking at long duration contracts, which are like life insurance type contracts, they were actually having implementation issues at the public company level. So much so that what we're going to find is they're actually going to delay the effective date for everybody. So you'll see SEC filers get an extra year, and then they give that 2-year delay for smaller reporting companies and other public business entities, and then everybody else. So you'll see here, this goes through it. Now remember, all of these charts are assuming calendar year reporting. If you have a fiscal year, you have to adjust, right? So you might be the following year for fiscal year ends. We're going with calendar year ends on all these charts. So hopefully that would help you as you go through this and thinking about the process. So one, we have new effective dates for 4 standards, and we have a new method, a new philosophy on how we're going to do this going forward. All right. Well, I want to thank you so much for joining me as we walk through effective date changes for 4 standards and a philosophy change. Have a great rest of your day. Bye, guys.